Welcome, welcome, wherever it is you're joining from. Good morning, good afternoon, good evening, from whatever time zone. The webinar today is going to be titled Making Consistent Income with Trendline Analysis and How Following the Crowd Can Get You a Daily Income. My name is Atomashi Dania, Forex mentor and trainer with Dream Big Investing. Welcome. So today we have 5 segments for you. We have the introduction, we have the definition of trend lines. What is this trend line? We also go into what the Tom Mark trend line is. We shall be talking about some trend line trading strategies with some chart examples and how following the crowd can make you a daily consistent income. So let's start with the first segment. Introduction to Dream Big Investing and the financial market. First and foremost, what is Dream Big Investing? DB Investing is a financial brokerage firm established in 2018 with a presence in 5 countries, namely Malta, Dubai, Cyprus, Seychelles, and Nigeria. We're a brokerage firm established in 2018. So, in talking about Dream Big Investing, it's important to delve into what we have today, how the world has evolved into an age of robotics, proper usage of the internet, and how it's become a norm making money online and at our fingertips. So we have come to accept that it's time to say no to depressing jobs in this generation without the need of having to stay there and slave for unappreciative employers for so many years with nothing to show for it. We have come to accept that there's a new norm, and this new norm is involving the practical usage of robotics and the internet. And in so doing, we have become more open to making money online, making money on the internet. So what exactly are we offering you? We offer you the opportunity to find your fate, create your own path. We bring to you the opportunity to have a peaceful and secure retirement. We bring to you the opportunity to be your own boss. And we bring to you the opportunity to trade different financial instruments in different markets. Now, to be more specific about our product, what exactly do we have in store for you? We provide you the opportunity to trade different financial instruments ranging from Forex to stocks, metals, cryptocurrencies, indices, and so on and so forth. Again, Forex, metals, indices, stocks, cryptocurrencies, commodities. What is Forex? Forex is an acronym for foreign exchange. It involves trading currencies in pairs in the foreign exchange market, and it has a daily liquidity of at least 3 trillion US dollars. And I always tell my students, because of this liquidity, just do your bit, capture your own fish, and walk away. It's like a sea. In that sea, or a river with so many fishes, just take your own bit and walk away. There will always be fishes in that river every day for you. But before then, what is this Forex about? Imagine you go to the Bureau de Change or the bank or somewhere to exchange currency. Say you have €1 and you have 40 euros and you want to exchange it for a US dollar. This is foreign exchange. Only in this time you get to do it on a platform that is designed to make sure that whether you're buying or selling, you're making profit. Now, metals. Dream Big Investing also offers you the opportunity to trade different metals in the market. From time immemorial, we have always traded via trade by barter, and then we moved on to using metals such as gold, copper, and silver in a daily exchange. Well, people still do that. We still trade gold, trade these metals on a daily basis for buy and sell positions in the pursuit of making profits, either in the short term or in the long term. We also offer you the opportunity to trade stocks and indices. Of course, I'm sure we know what stocks are, but some of us who don't know, The stock market is a market that involves trading the share price and the share price of different organizations, different companies. Um, Imagine Apple stock is being traded at $40 per share today, and they call out a public offering where you're coming to buy, you're being introduced to come to buy shares or stocks at a cheaper price, maybe at $20 per share. And then you decide to lock in 1 million shares. That's 1 million times $20 is 20 million US dollars. Now, in the next 5 to 6 years, Apple stock, for example, may appreciate from $40 per share, $20 per share to $100 per share. That's about 5 times. So, in 5 to 6 years' time, you have made 5 times your $20 million, which is around 100 million US dollars. But in the stock market, this is often not the case. This is the case only you get to do it in the short term and in the long term. And whether the stock price is falling or rising, you get to make money off it. Cryptocurrency. We've heard about the madness called crypto, especially Bitcoin. Now, as opposed to keep holding Bitcoin or keeping Bitcoin or any cryptocurrency in a wallet or in an account, you get the opportunity to trade it and predict where the markets roll, predict where the markets are headed early enough in time for a buy or sell position before the spot traders do so. In other words, if your friend has bought Bitcoin in July and the price is dropping right now, you who's trading through our platform can easily tell that from July it's actually going to start dropping, so as to know if it's a good position to buy or good time to buy or sell. In this case, you make money whether Bitcoin is dropping or whether Bitcoin is selling, or any other cryptocurrency for that matter. So we give you the opportunity to trade this on a daily basis and whichever time you choose. Tailored solutions for every trader. In trying to get accustomed to the market, we provide you with what is called demo accounts, the practice accounts where you have some amount of money which you use to grow and become consistent or use to trade. And after long-term periods or a short-term period of trading, you get to decide if you're ready to face the markets or not. So, the demo account. Live trading accounts, we have different types. When you start trading, you definitely get more details as to what that is. We also have the Introducer Broker Partnership Program. It's the world of networking these days. Tell your neighbor what we do, and when it comes to trade, you earn money from this, be it in a loss or win position. We have the Palm Investment. If you don't have time to trade the markets, you're welcome to try to invest and connect with successful traders who have had consistent records in doing so. You can contract them to trade your accounts for you, where you have us come in as a moderator. So say you say on the 30th of January you want to receive your profit from this trader. We help moderate it in such a way that when that day comes, the profit is shared based on the agreed percentage between you and that trader, without the need for one person having to call the other. Copy trading. So in case you're not so good at trading yet, but you know some very good traders and you want to copy their strategies or their style, there's a platform also for this. Now, to the next section of this lecture. What is a trend line? What is the trend line? So the trend line is an easily recognizable line that traders draw on charts to connect a series of prices together or show some data's best fit. The trend line is a line with a specific trajectory. It is drawn to connect a group of highs or lows, and the slope of that line determines the next level of support or resistance. It is usually used to give the trader a good idea of the direction in which an investment's value might move. Here we can see the trend line connecting a particular, in the FX market we have this called the swing lows, connecting the lows in price. This is what a standard trend line is. It connects not just 1, 2, 3, or 4, but groups of price positions. So here we see 1, 2, 3, 4, 5, 6. 6 times where price dropped and moved up in a regular form. The trend line was able to spot this pattern after drawing this. Now, again here we see on the chart what the trend line is, connecting this level here, and here, the trend line. Now, this is what the standard trend line should be. This is what the standard trend line is known for, is known to be. And the trend line, considering what it is, you see, it often occurs, there's a concept around it formed by the guy called Tom DeMark. There is always a buyer and seller at every price. When the volume of buyers and sellers increase at a certain level, the price has reached what is called equilibrium. If this equilibrium occurs near a trend line, traders will often call that level support or resistance. Now, we see trend line here acting as resistance, where it's connecting the highs. Here, we see the trend line acting as support, where it connects the lows. Now, for some of us in the house who don't know what support or resistance are, let's do a recap. Support and resistance are terms for two respective levels on a price chart that appear to limit the market's range of movement. The support level is where price regularly stops falling and bounces back up, while the resistance level is where the price normally stops rising and dips back down. What does that mean? First off, let's look at resistance. We see here price headed up, head to a particular level, came down, bounced off that level, came down, went back up again, touched that same level, came back down again the second time. Next, we see it touch the level the third time and refused to break past and move forward, or in this case, go up. And it came back down after touching the resistance line the third time, after heading to that level the third time. This particular level is known as resistance. For the support, it's the same thing, but only in a downtrend. In a downtrend, price came down, touched a particular level, reversed, touched it again a second time, and in this case, reversed. So what does that mean here? What are we trying to say? Let's go to the real chart and show you what that means. So look for the GBP USD chart and try to make it color on white. And let's look for the date on the daily chart, 20th of April 2015. 20th of April 2015. Yeah. So I'm going to put a vertical line right there and see what price did. Just around there. And 28th of August, around let's say the month of August 2015. So here we can see that price head to one level here. Okay. When it got to that level, it reversed, went back up to that same level, came down again the second time, and went to it the third time and reversed again. So the moment it gets to that level the first time and the second time, that level automatically becomes what? Resistance in an uptrend. Now, the trader would normally just draw a line right there, and just call it a resistance line and use that as a reference point for trading in the future. It's the same sense. Same daily chart, 12th of March 2013. 12th of March 2013. Let's try to find that date. Okay. Here we see price go down in a downtrend, just around here, between here and here. It touched this particular level, went up significantly, came back down again to that same level, took about, started from the 8th of January 2012 and did that up until the 4th of April 2012. No, the 4th of June 2012. So what happened? When it touched that level the second time, price started to do what? To reverse. This level is automatically what is called the support. You could draw a horizontal line right there to tell you that it's a support level. So traders will normally trade using this level here as a reference. Now, for some of us in the house who are veteran traders already, what exactly is this support and resistance? How do we assess it? We know that we can do that using historical price data. We can do that using previous support and resistance levels. And we can do that using technical indicators such as trend lines, pivot points, moving averages, and Fibonacci. So what does that mean? We see this. Imagine here, historical price level. This happened on, what date was this? 29th of April. And this, when price got to this level on 29th of April, assuming we were here in price, and we're trying to assess if this is a significant resistance point or not. But we can see that it got to this level in the past, 26th of April 2012. And assuming we're here on this date right now, we wanted to know if price will respond or not. So the logical thing to do would be to draw a resistance line there and watch for price reaction when it gets to that level. And look, as soon as price touched that level, it reversed. In this case, we're using historical data, previous swing highs and swing lows in the past. In this case, it's the history of this particular currency pair, GBP USD, where instead of pushing past 1.62645, it reversed on the 29th of April 2012. We could also use this line as a reference point in the future. Say we're trading going forward. We can see that it came down on the third time in the future, December, January 2012, touched that same line, price reacted to it, the market reacted to it, hit that level, and reversed significantly reversed. So this is the case of using historical data to assess resistance and support. Now, in the case of technical indicators, we're studying one of them today, trend lines. We could also use pivot points for those who come to my class. I'm sure you know what pivot points are already, moving averages, Fibonacci, and so on and so forth. Now, it's important to state some few points about the trend line strategy. You see, applying the trend line strategy on the chart varies per trader. It is often difficult to formalize the right choice of points in the construction of trend lines. If you ask 3 experienced traders to build a trend line on the same chart, you would often get 3 completely different outlooks on the market. Why? You see, the market is vast, and there are millions of traders in the world with different strategies, and hence, no man is an island. In the world of trading, no man is an island. I keep saying this, and some of my students already know this. Now, next, what is the Tom Domark trend line? That's the next section. The concept of trend line is often treated ambiguously and inconsistently. Unfortunately, in most cases, the procedure of trend line drawing is subjective. Many trend lines can be built, but only one is true. Thomas Domark has developed a methodology of objective selection of 2 points to build a trend line, and the application of this method resulted to a technique of trend lines, graphical analysis, in which the graphical analysis and the usage of trend line lost its former subjectivity and became a purely mechanical procedure. Tom Domark emphasized on 2 things. 1, abandon drawing trend lines from left to right. And second, the current price movement is more important than price dynamics for previous days. So the trend line should be plotted from right to left. This was the second point Tom Domark insisted on. Instead of drawing from left to right, Tom Domark insisted we draw from right to left, taking into consideration price dynamics for that particular moment in time. So the right-hand side of the chart is the most recent data on the market state, according to Thomas Domark, this guy. So, in understanding the use of trend lines, let's first try to get the basic idea as to what Tom Domark was talking about. In standard trend line drawing, um, strategy or knowledge, this is what we do. We draw from left to right. But for Tom Dumark, he said thus. Instead of doing this way, draw this way. Right to left. Now, how did he apply that to the market? What does that mean for the market? Let's see. In order to know this, in order to understand this, we must first of all come to an understanding of what the rules for drawing trend lines are. So we start with the rules for drawing trend lines in a downtrend. In a downtrend, you connect the highs. It means first you look for the most recent or nearest swing high to price and call it point K. In this case, point K. Here. What is a swing high and what is a swing low? Let's do a recap for beginners in the class. A recap of swing high and swing low. What does it all mean? So imagine you have 3 candles. 1, 2, and 3. 1, 2, 3. And we have the low here, this guy, of the second guy, lower than the low of the one on the left and the one on the right. These 3 patterns are called swing lows. Swing lows. Now the main candle of this swing low is this guy right here, number 2. Swing low, ladies and gentlemen. Now let's do a reverse. Assuming in an uptrend, for example, we have something like this. One, 2, 3. So the high of this guy is higher than the high of this guy, and higher than the high of this guy. These 3 candles are tagged swing highs. Swing highs. The main candle of this swing high is this guy right here. Number 2. So what does this mean? If we go back to our lecture, we'll come to see that here we have a group of 3 candles, assuming that we are right here in price. This is where we are at this particular moment in time. We have 1, 2, 3. You see that the high of this guy is higher than the high of this guy, and also than the high of this guy, higher than both candles. We'll call this point K. Next, we look for the swing high before it that is higher than it. Look for the next swing high immediately before point K that is higher than it and call it point J. Let's go. So the next swing high before the K that is higher than it is this guy right here. 1, 2, 3. The high is higher than the one on the left and the one on the right. Point J. So the rules for drawing trend lines state that we should connect K to J. If we connect K to J with a straight line. If we connect K to J, this is what we should have. K to J. Right here, K to J. Now, the next rule for drawing trend lines states that when you've connected K to J, extend it from the point of K to the right. So it says extend K to the right with a straight line. If we do that, we do this. Extension of K to the right, K to J. If we extend K, it's right here. We see that right here. So how do we apply this to the markets? It's simple. The next thing to look out for once we've drawn K to J and extended based on Tom Dumark price analysis, trend line analysis is thus. The trend line breakout strategy. I'm sure many traders already know about this. If price breaks and closes significantly above the trend line, expect a continuation or reversal of price upwards. This is what we have. So if price breaks it right here, closes significantly above it right here, look at what happened. We call this a breakout, trend line breakout. If that happens, it is predicted that price will continue what? Upwards. And look at price. After breaking the trend line and closing significantly above it, we have an upward continuation of price. In this case, a reversal. So what are we talking about here? Remember, when analyzing the trend line, we were analyzing the trend line strategy in a downtrend. So when we extend, we get a breakout and an upward movement in price. If this was a continuation, it would be an upward continuation. If this was a reversal of the downtrend, it would be an upward reversal of the downtrend. Now, there's an unwritten rule pertaining to the trend line breakout strategy. An unwritten rule that one doesn't often find in literature. The rule states thus: price often, which is at least 50% of the time, goes back to retest the trend line. Goes back to retest the trend line. Happens in this case. Price broke, went up, and then came back down to retest the trend line right here after pushing above it, after pushing through it. We have this called a retest, the retest of the validity of the trend line. Okay, so that's that for trend line in a downtrend. Let's do the trend line in an uptrend. It's the same sense. In an uptrend, connect the lows. So we'll go back to the chart and try to look for where we have an uptrend. This is a massive opportunity here. Look at this. Assume we're right here in price. I'm going to zoom in a bit. I'm going to zoom in. If we're right here in price, and we have, we're trying to assess where price will come in for a reversal. We have seen that this is massively overbought. My students will know what the overbought strategy is about. We've seen that this is a long trend that went from 17th of March to 16th of July. Now, what happened here? As opposed to the swing high, in an uptrend, what's the rule? Connect the lows. The swing lows. What's the first swing low in relation to price? 1, 2, 3. We see it low here, lower than this, and lower than this. 1. And next, we look for the next swing low before it that is lower than it. This guy. This is lower than this and lower than this. If we call this point J, K, and call this point J, we're connecting K to J. And the next rule says extend. If we extend, what do we have? We're extending to the right. That's the next rule, ray to the right. Oh, in this case, okay, we drew it from left to right before. Let's do that again. We extend. This is what we have right here. A break. Price broke the trend line and continued downwards. In this case, this was a massive reversal of the uptrend. Went down massively. Now, I told you before that there's an unwritten rule that 50% of the time, price often goes back to retest the trend line. Yeah, this is the case 50% of the time. We can see this here as a fact, because here, instead of going back to retest the validity of the trend line, price just continued moving down and down and down. And look, if you had traded from here at the break of the trend line up until here, that would have been a drop of about, oh my goodness, that's almost 2,000 pips. Yes, about 1,000 pips. That's $10,000. That's about $10,000 on a standard account. So imagine you had sold here, you traded a standard account, even if you had used the smallest lot size. For those of us who don't know what the lot sizes are, come to my class, sign up, DB Investing. We have an online training coming up every Friday going forward. Come on board and let's get you what you need to know to start trading the market. So in this case, the breakout, after trading the breakout, we would have had a massive drop. And if we had traded this massive drop on a sell, this would have been 1,000 pips. On a standard account, on one lot size, 1,000 pips is actually 10,000 US dollars, just like that. So swing traders in the house would have had a massive and swell time enjoying the trading of this particular currency pair using trend line breakout. Okay, let's move forward. Now, let's talk about some consistent trend line trading strategies for reversals. Consistent trend line trading strategies for reversals. Consistent trend line trading strategies for reversals. Before we started this class, this lecture, we talked about the 4 different segments. Some of us may be experienced traders in the house, and we may find this very useful for those of us who are experienced traders, very useful going forward, because we know that in the trading world, no man is an island, and every knowledge, there are different strategies out there. What I know may work for me, but may not work for the other person. One man's food is another man's poison. However, there are some consistent strategies that have been found to reel in at least 70% consistent wins when trading the markets on a daily, weekly, or monthly basis. So let's go forward. Next, reversal patterns after a long trend. Reversal patterns after a long trend. In applying the trend line trading strategy, let's start with the first strategy. Reversal patterns after a long trend. Let's go to the chart. What does that mean? For example, we're analyzing this trend right here. We saw that price went up from the 3rd of July. If we put a vertical line where price started going up from around the 7th of July and kept going up and up and up and up all the way to the 15th of July 2014. One whole year. This instrument kept going up and up and up and up. One whole year. Okay. Of course, there are entry points along the line. But assume we've been trading and we follow this particular currency pair for one whole year, and it got to a massive level here where it's been going up for one whole year. That is already what you call a super long trend. Very, very, very long trend. Okay, let's look at the next step in our strategy. Reversal pattern after a long trend plus overbought or oversold market condition. So in assessing that this is a long trend, we also want to see that this is markedly overbought. It's in an overbought level. My students will already know how to assess what overbought levels are. The next step will be to use an oscillator called the Relative Strength Index, RSI. At the RSI level, if we look at that particular level there where price stopped moving up, it's above the 70 watermark on the RSI. There are 2 watermarks on the RSI, the 70 and the 30 watermark. If it touches and goes above the 70 watermark, it's overbought. If it touches and goes below the 30 watermark, price tends to be oversold. So here we can see that price was markedly overbought here on the RSI. We've confirmed that. So what's the next step? Now we're looking for reversal patterns. My students already know what these reversal patterns are, but let's just look for them one after the other. What reversal patterns can we spot here? We have this here. We have a hammer. We have a spinning top. We have a doji here. We have another doji. We have a spinning top. We have a doji. Okay. And in considering dual or 2 candle patterns, these 2 candle patterns are engulfing patterns. Engulfing patterns. In going further to consider complex patterns, 3 candlestick patterns, 1, 2, 3, this is called the evening star. So let's go one after the other. First, we have a long trend. Next, we have the overbought. Next, we have hammer, 3, the 3rd signal, spinning top, 4, the 4th signal, 5, the doji, the 6th signal, the spinning top, that's the 7th, the 6th, the doji again, the 6th, The doji again, the 7th. The evening star, the 8th. The engulfing pattern, the 9th signal. We've got 9 signals right here. And for those of us who are who know the candlestick patterns or who've been following my class both online and physically, we can easily spot that there's another pattern right here that hides just around here. If we consider these two patterns, this is what is called a harami. Beginner traders in the class, have no fear, don't fret. They're just names and the way candles appear, candlesticks appear. You want to know what they are, sign up, come online, send a DM, talk to your account officer, and you get all that information at your fingertips. This is a harami. 11, the 11th signal. Okay, we've established that. We've established reversal patterns in a long trend, in overbought and oversold market condition. Now let's see what next. What's next? We see all this plus gap. All this plus gap. Yeah, star pattern in this case. We have a star pattern here. This is called an evening star. 1, 2, 3. Plus a gap. Let's see if we have a gap. My students already know what the gap is, but let's just plot the moving averages to get what the gaps are. The 8 exponential moving average comes first. The next we have the 14 simple moving average. Now let's see. We'll give it a red color. What's the gap? Right here. If we add on the grid and make the grid a bit of gray, dark gray, we can tell that there's a wide gap between the 8 exponential here and the 14 simple moving average, and a wide gap between the reversal candle and the 8. If we merge and measure this gap, we're going from here to here. That's about 1.5 boxes. My students already know what that means. It means the gap is significant enough to tell us a reversal is imminent. So, what do we have after? What's the next step? The next step says trend line breakout. The core and the focus of the lecture today, trend line breakout. Once we've had all these signals, 8 reversal candles, 11 reversal candle patterns, long trend, overbought condition, gap. What else is next? Now we want to know when to enter, when to place a sell. The next thing to do here will be to draw the trend line, which we have drawn right here. If we connect, let's do that again for those of us who are coming in for the first time. We're going to draw from this swing low to here and extend to the right. The breakout of that trend line caused this reversal in price, or rather signified to us that this was the best time to sell. And look at what happened after. Price dropped massively. For those of us who trade one standard lot, this would have been a $10,000 profit opportunity trading the GBP USD daily chart. So that's it, ladies and gentlemen. First off, we considered reversal patterns after a long trend. Next, we considered reversal patterns after a long trend, but in an overbought or oversold market condition. Next, we considered reversal patterns plus the gap. And then we went with reversal patterns plus overbought, oversold, plus the gap, and then the trend line break. So some of us who are expert traders in the house will ask, what's the essence of all this setup? Why all these strategies? Because you see, trend line analysis only often has 50% win rate if used alone. And personally, in my experience trading, I find that trading trend lines and applying it with different strategies, with different setups, experienced traders will know what setups are, is easier, or rather has a higher win rate. If, for example, you tell yourself you want to see reversal patterns plus gap, reversal patterns plus gap plus long trend plus overbought, oversold before you apply the trend line, I assure you, you're going to have at least a 70% win consistency rate when trading the FX market or any other instrument for that matter. If you're a pensioner, if you're someone who just doesn't have the time or strength to sit on your computer or your phone with your phone all day to analyze the market, you can write in your diary somewhere, set it in your mind, register it somewhere. I want to see all these setups. Reversal pattern plus overbought, oversold market condition plus gap plus trend line break before I apply the trend line breakout strategy. If you do this, be it on any instrument or any commodity, any crypto, I assure you, you're going to have at least a 70% win consistency rate. Take that from me. Now, with good practice, you can grow that 70% win consistency rate to at least a 90%, 95%, but never 100%. Okay, let's go on, ladies and gentlemen. Now, the next part of this lecture is following the crowd can earn you a daily consistent income. The question you would ask is following the crowd profitable enough to earn you an income in the financial markets? Yes, that's my answer. How do you do this? You see, in the financial markets, especially Forex, following the crowd is another name for following the trend. Following the crowd is another name for following the trend. In the financial markets, price often moves from the outcome of the battles between bulls and bears. For those of us who are trying to affirm what bulls and bears mean, bulls means buyers, bears means sellers. If there are 10 million buyers of Euro USD assets and 2 million sellers, okay, and even though you know that in the long run the sellers of that commodity may be right, it's often better to either wait for the buying momentum to slow down before joining the sellers to take over price movement, or you just simply join the buyers while they are enjoying the temporary glory. So if you have 10 million buyers in the next 1 hour of a particular commodity, but you know that this particular commodity is still going to drop in price, okay? If you really want to enjoy trading this commodity, it's actually very ideal to follow the buyers to buy within that 1 hour. So some traders who are conservative will wait for the buying momentum, the buying madness to end, while others may just go with the buy, finish the buy trade, and then switch to the sell. This is actually called following the trend. Following the trend. Now, you see, following the crowd or trading the crowd psychology in the FX market or any other market for that matter is like the tide of a sea. In the times of old, when sailors used the wind to drive ships, a common saying was often heard, which is follow the tide. In the FX market, applying the trend line breakout strategy the right way can often tell you where or when the tide is present. You see, at the end of the day, the trend is your friend. And it's expected that as you trade with the trend, as you identify the trend rather, you do what? You trade with the trend. Trend line analysis can help you when applied the right way. Trend line analysis or trend line breakout strategy or Tom DeMark trend line breakout strategy can help you identify the trend and can help you trade with the trend. This key point, I'm sure, is very valuable for experienced traders or intermediate traders in the house. So today, I don't want to talk too much about trend lines. And for most of us, a common saying goes, majority are fools. In the trading world and in the financial markets, majority are not fools. The majority carry the vote. Majority determine the market. In any financial market whatsoever, the trend is your friend. Trade with the trend. So, ladies and gentlemen, I leave you today with these few points about trend line analysis and how you can follow the crowd using trend line trading strategy to make consistent income while applying the strategies mentioned or talked about in this class today. Going forward, let's try to do some practice. And if you have problems, I want to talk about how to apply or implement them on your charts, you can always buzz me up. Talk to your account officers to reach me anytime within our business hours. Dream Big Investing in Lagos, here, Allen Avenue. Thank you for this class. Thank you for joining in. Again, whichever time zone you're tuning in from, thank you, thank you, thank you, thank you. Good evening, good afternoon, good morning. Bye bye.